Yeah, hi, good evening, and thank you for making time for this webinar. Uh, Two agendas really for the day, and I think Krishna will be uh, the person who will speak the most and will be happy to take questions. But I just thought I'll spend a couple of minutes just reflecting on what's happened in the last month, which is obviously quite a lot, and also reflect on giving you some background, some business background in terms of the launch of our new fund, which is coming up on the 27th of this month. So, obviously, in the last month, I think we've seen two situations emerge, which I think for all our distribution partners, I spent a lot of time traveling and meeting with many of you. And the sense I pick up is that we have market volatility at one hand, which is a mix of economic and geopolitical events that happen. And on the other hand, you have a situation where the market per se, in terms of its trajectory, continues to remain reasonably range bound and sanguine. And so, customers allocating more money at this point in time is turning out to be a tougher and tougher task. Now, we can all talk about the fact that we tell our customers that if you're investing for the long term, the India growth story is still intact, etc., etc. But it's easier said than done, right? So the reflection I would have with you, and I think I've spent some time on this in previous webinars, is that this is probably time while obviously flexi cap and multi cap funds probably make the most sense from an equity standpoint. But looking at the balance category, in particular the aggressive hybrid and potentially multi-asset, also perhaps make a lot of sense. I can also tell you anecdotally that in our own particular product range, one fund that seems to be getting a lot of interest, which is I think in context of where markets are, happens to also be equity savings, right? So I would say that a mixture of equity which is diversified, as well as pushing clients to look increasingly at products that are a little lower on the risk spectrum compared to pure equity. For example, aggressive hybrid and multi asset is perhaps an easier way to convince customers to come in, obviously with a long period of time in terms of their time frame, than trying to sell a pure vanilla fund. Now, coming to the NFO, sectoral NFOs are always fairly unique because they are, in some sense, catering to a niche part of a client's portfolio, right? There is never going to be a situation that a sector fund becomes 30-40% of a client's portfolio in terms of one particular sector and a bunch of funds representing that sector. Sectoral NFOs are Sorry, I'm not sure if my audio is back.
It's audible now.
Yeah, it's back. Yes.
Yeah, sorry, I think there was a bit of a hitch at the point. Yeah, so as I was saying that if there is one sector that is able to transcend all these opportunities across the economy, it tends to be banking and financial services. Our stance has always been very clear that we launch a sectoral fund provided we have the same view across our diversified funds, right? So, in basically the banking and financial services space, we have been relatively overweight in a number of our diversified funds for quite some time, and we thought that we should give it a more focus in terms of a specific product. Also, additionally, I'm happy to announce that we have a couple of new members in the team who have a lot of experience looking at this space, particularly Chetan, Kirti, and Vishal. And along with Krishna, I think we feel very confident we have the right tools to be able to produce, you know, a decent outcome for this particular fund in the years to come. So I'm going to stop here and I will turn it over to Krishna to give you a flavor of how he's seeing the market. It's not an enviable task. I think every single new day you present a market outlook, you have events of the past day that have a deep influence, but I'll leave Krishna to that unenviable task and also to give you a sense of how we think about banking and financial services in terms of the fund that we're launching. Thank you, and I'll happy to take questions. I can see a couple of questions on the chat as well. We'll answer them as soon as Krishna's presentation is done, which shouldn't take more than, I'm guessing, Krishna, 20-25 minutes. Yeah,
Yeah,
over to
I
you.
so good evening, everyone, and yeah, I'll just switch on the maybe presentation for the time being. I hope it's visible.
Yes, it is.
Yeah. So hi, as I said good evening, and yeah, Anthony, agree. Markets are more and more dynamic. Unfortunately, one part of this dynamic behavior of market really is that it's driven more by announcement, more by extreme short end positioning by investors globally. uh, and in many of these cases, the origination or the data source for this announcement happens to be US, whether we call it tariff or war, peace, ceasefire, truce, tariff war again, etc. I think those issues, is I think we have to go through this journey right now with the reasonable belief that almost everybody in the world financial market has the same challenge, which says that yes, there is something changing in US. Possibly, if you really relate to it on an extreme, analytical perspective, what's changed in the world in last 12, 15 years, especially post this GFC, let's say 17 years in a way number. US economy has gone into a lot of leveraged support system through a combination of extreme monetary easing. Quantitative easing was the word in the first 10, 12 years from GFC. Post COVID, the monetary easing in a way remained active, but it was over and above that supported by financial easing, which is in our language, fiscal stimulus. So you have a situation where last 15, 17 years, a lot of money supply excesses have happened either because US Fed gave a lot of money or because US government gave a lot of money, and to an extent, some of the challenges of unsustainability of incremental fiscal stimulus is what's it. Somebody somewhere possibly needs to change the direction by doing some new things. Maybe tariff is just one part of it. Possibly, some sort of a currency adjustment is playing out. And right in front of us, you have actually we are seeing a US dollar index, or US dollar reasonable depreciation vis-a-vis the world currencies. Some of them are part of those adjustments which we are going through, and to that extent, I am repeating maybe that maybe Indian markets and Indian investors are not the only one being exposed to these volatilities. Yes, clearly, war is something which came up. Even if you look at a war perspective, we had a Russia Ukraine somewhere in early 22, then later on became Israel and Gaza, and possibly now Israel Iran. So I think those things are playing out, which adds to this volatility in the markets. But essentially, one way is to look at it is it's actually a US fiscal, US monetary policy stimulus of last 15, 17 years, which the government is trying to unwound. I mean, I'll tell you one very interesting article came up last week in newspaper saying that US has actually announced this perspective where US is going to give a golden card, which means American citizenship to people, and as per the news article last week, some nearly 70,000 people have already applied even before the scheme is opened up formally. Which just to give a context, The golden visa costs something like $5 million per person. If we actually have 70,000 people, it works out to something like $350 billion. As per that same article says, maybe the target is something like 2 lakh people applying, which means $1 trillion kind of money flow to US economy. It's a pretty large amount of money. Honestly, I can't really think whether something like $1 trillion can be raised by offering citizenship in US. But yeah, that's what maybe another perspective I can think of it financially, uh, you know uh, getting people into the country by paying that price or a cost of US citizenship. So US is trying its bit, and yeah, financial markets are so much interlinked nowadays that one announcement happening in Japan, Germany, Russia, China, US, thus is an implication because investors are common. Investors have multitude to choose among countries, whether you call it developed market, emerging market on one side, or within developed market, US versus Europe, or Japan versus Europe or US, or maybe within emerging markets. Some other facts, quite interesting facts, is that in last 6 months, suddenly there's been some sort of a change in market leadership. So Europe has actually, come out as a better equity market performance vis-a-vis US, especially when you look at in a dollar terms from investor, because what was made in US equity perhaps has been in a way lost or reduced because of US dollar depreciation for global investors. The way we track FPI, there are every other country tracks FPI because there are European investors looking to invest money. There's Japanese investor looking to invest money across the markets, whether it's US, and they all finally want returns in their own currency. So to that extent, a US dollar depreciation possibly hurts them in their returns. So maybe they are more better off being in their own economies from a equity market perspective, is what I'll say. Yes, I agree. It's very difficult task right now because news flows, you know, in less than 3 months, we've actually seen the in the full circle of tariff being announced and tariff being possibly kept on hold, and then suddenly from nowhere we got China, which ended up negotiating tariffs far ahead of other countries. So things are evolving. Maybe somewhere by mid-July, which is what the 9th July deadline, a lot of clarity can come in on tariff front, allowing which set of sectors can benefit or can be impacted based on what US does on bilateral trade terms. India being one of them, will definitely find our own answers to which sectors can benefit and which all companies can possibly have a lion's share of the incremental profit pool coming out of this opportunity. Sharing some things on on BFSI fund, as Anthony mentioned, that's our new offering which launching this week,
Krishna,
Friday.
can you turn on the full screen if you can?
This is visible.
Yeah, but it's still showing as a.
It's
Can you log out and do it again? Reshare it.
Is this better?
No,
No.
it's still not
Is
showing
it
the
in a
full
PPT
screen.
mode? Okay, sure. Just give me a minute. Now,
No, it's not because I think you have to open it as a full screen in your PC first and then start to share it. I think in the interest of time, you can
no, no.
probably.
Just give me a minute here.
Yeah, it
You can
seems
see,
to be
yeah.
full screen now. Yes.
So yeah, we'll be launching this fund on this Friday, 27 June, and it closes on 11 July. To sharing some broad thoughts on BFSI, the way we look at it as a sector, maybe now, maybe in the past, how it has evolved over time, and what possibly one can think of. So this is one core slide. If I have to really summarize, maybe from an opportunity perspective on demographics and economics combined. Two pictures speaks for themselves. On the right side, we have this curve of GDP per capita. This is basically rupees. I'm sure normally many of us are used to seeing in dollars. The reason why it is should be seen in rupee terms at some stage really is because that's the rupee is going to be spent in India. It's going to be invested in India rather than dollars, which does have its own ups and downs because of how currency moves. So we're talking about roughly 2.5 lakh rupees kind of GDP per capita in India right now, which possibly was maybe as low as 5,000 odd rupees some 30 40 years back. So that's one journey. As an average Indian starts earning more money, his ability to spend, his ability to save, his ability to invest, etc., changes over time. And the picture on the left side shows how the household income distribution in terms of which here the number of households split between high income, upper middle, lower middle, and the low income category shifts. Uh, in a way, this linearity is similar in both the sides. If moment we start seeing a rising per capita income, the shape of this particular cone of 2005 starts shifting with a more bulgy curve, and it's likely to be more bulgy going ahead. And that also means that more Indians will be in a higher income category, more incomes will Indians will be in upper middle class category. So if you had, let's say, only 1 million people in higher income category in 2005, we likely to have something like 29 million people in 2030. We already would have crossed, I think, uh, 15 odd million by now is my guess. Maybe 17 is a fair guess I can make, considering we were in 2018 at something like 8 million. So the picture here is, as India is increasing its own GDP growth, nominal growth is coming up. It goes to people, it goes to households, and we have now better quality spending power for consumption and better quality power for savings and investment. So that's one particular slide which basically says uh, you got rising household income, which will give you higher saving, higher demand for financial products and services. So BFSI structurally, let's say, benefits. How do we look at BFSI in this space? You can look at BFSI on two sides of the equation. One is how BFSI is contributing or benefiting from the household saving side, on the financial saving side. Other is on the financial liability side. So that way BFSI is ends up becoming both a customer to any a service provider to any customer on both sides. Somebody wants to invest money, somebody wants to save money. BFSI is some combination of companies are available. Somebody wants to borrow money for their own needs on consumption, asset creation, etc. Again, BFSI as a pool is available to service that customer. So you actually have this unique situation, and as more Indians are going to be coming into that spectrum of financially affordable class. If I go back to the previous slide on that, bulgy middle class, one can easily think more and more people in India will become eligible to borrow vis-a-vis where their current credit score permits them, because as your income goes, your affordability so does go up. So that's one part. Another part of demography is that India is still a young economy. So when you have a young economy in terms of average age, median age population, you have far more people who are yet to enter the job market, and more people yet to enter job market means more income creation. uh, as we know, the financial service interaction with a customer changes over time. uh, a just born child goes directly with a savings account or a PPF account at on day one kind of stuff, while over a period of time the customer moves into a possibly education loan category, at some stage starts earning and starts saving and then investing in mutual funds, in markets, maybe buys protection policies through insurance, and goes into maybe exchanges, capital markets, AMC, etc. So that's the journey of a consumer. It requires income growth on one side, and that's what possibly India offers a lot because of our nominal GDP growth rate, the way it is right now, likely to go further in terms of size and scale. That's a BFSI. How BFSI over last 25 years have shown a rising profit pool in India, which means in a way BFSI has grown much faster than the average profit growth in the corporate India. Uh, Again, link it to how Indian economy would have moved in terms of size and scale, the per capita income, the rising middle class, rising upper class combination, and the ability to borrow, ability to spend, which flows from the previous slides, just conveys, at various points of time, BFSI has kept on, increasing its thing. Yeah, there are challenges, there are trade-offs where some other sector does well for some point of time, or the sector has its own challenges, which was witnessed in past. So what are the key challenge, BFSI goes through? BFSI goes through a key challenge, which is basically some sort of asset quality concern. So with that comment, I'm splitting this particular slide or this particular profit pool into two components, and somewhere FI 17-18 is perhaps a nice split point in my mind. So what this 17-18 time frame says, that's a time frame when India implemented massive reforms on the credit quality side or the asset quality perspective. So one is on a corporate side, we implemented, in this IBC insolvency code or NCLT redressal mechanism where existing promoter will be in a way forced to, be get out from the promoter role, new owners come in and step in to replace. From a retail credit perspective, what was implemented, was this uh, Jam Trinity. What was implemented was, CIBIL score based, lending process. What is also, important is that now almost every customer can be tracked via their Aadhaar card, PAN card, mobile combination, which also improves, ability of a lender to track the customer, ability of a lender to follow up for repayment, and somewhere that CIBIL score worries or allows a slight better quality repayment mechanism vis-a-vis the earlier situation. So I'll show that that particular piece is pretty relevant to this rising profit pool combination, and where we expect the cycle to be different vis-a-vis the earlier phase where quite a few banks were taking haircuts on corporate loans, on retail loans, etc. Look at the entire market size, scale of how BFSI market cap breaks up. This is basically 174 companies which we've taken with about 1,000 crore market cap each. So 174 companies in India in BFSI space have market cap of over 1,000 crores each, and when you aggregate, it actually becomes 104 trillion, 104 lakh crore market cap belongs, and broadly split between private banks, public banks, diversified NBFCs, infra NBFCs, insurance, both general and life, and capital market sites, which is exchanges, brokers, AMCs, fintech. Nice combination to pick and choose stocks within those entire gamut. There are subsectors, banks, cap market, NBFCs, fintech, etc., and reasonable choice of large, mid, and small available. That's the entire. I'm sure going ahead we'll have quite a few more companies being added to this pool of investment. This is the migration of this particular let's say this market cap or this 174 companies. If you look at other way dynamics, so one way to look at is your BFSI weightage in Nifty 50 has grown over time. It was 14.5% somewhere in 2004, which is more closer to 38% in as of March 25. So that's rising weight in Nifty. The figure on the lower is equally interesting. It basically says that somewhere in 2005, what was the split of market cap between banks on one side, NBFCs on other side, and all other players. So you got nearly 85%, nearly 15%, and the residual 1% coming between banks, NBFCs, and the insurance. And then you look at it the other side, how that market cap pool has changed over time from 2005 to 2025. The 85% became 70% and then 57. Effectively means a lot of other players entered, a lot of other subsectors of market evolved. In 2005, let's say we didn't have a capital market or a fintech. Now we have both the combinations. We've got new players entered. new listings, etc. And that's the advantage. And as I possibly mentioned earlier, these are the beneficiaries of economy. As economy grows, money in hands of people increases. One of the famous quote, which we've been witnessing in last 4 5 years, is that a nation of savers is becoming nation of investors. And as more people are investing, things like capital market, things like fintechs, maybe insurance does come into play. More money flows there. Maybe they are high P segments. It's another interesting part of markets. Typically lenders are valued more on price to book, but the other set of players are of valued more on price to earning. And that's the value creation happening on those perspective also through the new age financial companies. That's the future, kind of likely listings based on all this public information about what these companies are currently, let's say, valued at or likely to be valued. In fact, one name, if I have to highlight over and above this list, possibly based on the last week's some announcements, were that even possibly NSE is trying to get itself listed. Hopefully, it will also be one more investable option going ahead in this journey of Indian economy and BFSI space. And that can also be pretty large relevant market cap from that perspective, based on how the newspaper articles talk about the current valuation itself. Yeah, and so that really going to add to more and more investable opportunities as these companies come up to listing. We'll have options to go into more and more fintechs or more and more capital market related plays. So that's a other way to look at prospects on the core banking side. How banking sector asset quality ratios have improved over time, and that's where that 17 18 cutoff of insolvency bill and credit bureau for retail does played a nice role. We've seen quite a few instances where large companies have seen change of hands in terms of promoter name changing, because the new promoter ended up buying out the loans, stroke settling with the banks. And luckily for some of these banks, some of these cases, banks actually got almost equal to what the original default amount was, not much of haircut. The second picture talks about how private sector banks have evolved over time in terms of gaining a market share of credit. 57% is public sector banks and 43 is uh, the public sector. Sorry, 43 is the private sector banks. And the picture on the bottom just gives about how systemic ROA ROE profile have undergone change. Those troubled years of 17 18 19 honestly were driven by those asset quality related changes, and now that things are back, I think we on a pretty good spot overall. This is our own business, let's say mutual fund, as well as many of you have your own similar role. How we've grown as a category. Indian AUM of mutual fund industry AUM 72 trillion rupees approximately. Our own AUM as a percentage of GDP, as well as so a little bit change. One is FY, other is CY, but more or less data points are pretty similar of how we've grown as an industry. At the same time, leaving quite a bit option on the growth vis-a-vis the world. If you've seen how other economies moved into this higher income category, higher per capita income, and kind of wealth creation would have happened through mutual fund route is one option. Similarly, on life insurance and general insurance combined, how uh, those two industries have evolved in Indian context. Just for context, somewhere in 2000, Indian life and general insurance industries were privatized. So till 2000, maybe the private sector share was almost zero because there were no players there. Shares have evolved over time, and we've seen quite a few insurance companies being listed on both life and general over time. Again, on this side, India's penetration on life and non-life looks pretty low vis-a-vis the global standards. So there too we have a growth. Again, need to protect actually comes once have higher income, higher wealth combination. That's what possibly we are added for as an economy. From a regulatory environment, yes, we have three regulators: RBI, SEBI, and IRDA, each trying their own bit on improving the governance. They have their own nice entry qualifications for people to enter. So it creates an entry barrier for people only relevant or better quality promoters can enter these businesses. And This all the regulators do monitor, service standards. So in a way, core play on demography, rising per capita income. Maybe some of this is a repeat of what I was mentioning, so I'll possibly skip it in detail. That's about what this particular fund has. The benchmark details as of 31st May 2025. We got nearly 70% in private sector banks, around 10% NBFCs, public sector bank around 7, and remaining capital marketplace. If I superimpose this vis-a-vis the kind of market cap creation which we've seen, this offers nice ecosystem for fund managers to pick and choose so-called sectoral calls within the BFSI space, because each of these sectors has their own distinct characteristics of what will make them earnings grow, or the wealth creation or value creation happening. Different phases of cycle. If you are in a rate cut cycle, maybe NBFCs does better. If you're in a rate hike cycle, maybe banking sector does better. If you are in a bullish phase, maybe capital market related companies do better. So this it's a mix of multiple opportunities. That's where from a fund management side, active fund management of choosing the right pockets of opportunity, creating the portfolio, and then monitoring for valuations can allow some sort of a diversification across space. If you look from a performance perspective, how vis-a-vis Nifty 50 and Nifty financial TRI has happened over this last maybe 21 years, June '04 to June 25, broadly 21 years. How this journey has been for BFSI as a space through Nifty Financial Service Index. Nearly 4% CAGR difference between the two on this longer period of time. If I try to split this picture into a yearly combination, and out here we've chosen some other index called Nifty 500. So it actually captures both Nifty 50 as well Nifty 500 in a different ways of presentation. We got each year statistics on a calendar year basis about how financial service index has done vis-a-vis Nifty 500 for that year. Yeah, you got a situation where CY23, CY24 were a little bit on a weaker side for financial service vis-a-vis the broad markets, and that's where we see opportunity, saying that this kind of underperformance for 2 years possibly can get captured, because net one way to look at it, financial services is a bloodline for an economy, and that is doing well, so this sector too will follow. That's a little bit about fund. Minimum 80% to be invested in the BFSI space, and the remaining 20 has some option to go into other sectors if required. That's your universe captures almost all those names which are available, part of that benchmark or the market cap split. But yeah, we do have reasonable opportunities to do our own bit of sectoral picks, or our own bit of uh, cross beneficiaries, depending the same event, how some of these players can benefit, while other may be relatively lesser beneficiary within the space. So again, active fund management opportunity. That's a little bit of how typical portfolio gets constructed. We got 150 plus ideas, uh, can easily choose 75 plus investable ideas, and then create portfolio based on those macroeconomic indicators or policy environments or growth, earning growth, etc. So that's our broad thought process. That's a GCME approach which we follow, and needless to say, it's the same going to be applicable here also. So that's mainly from our side. Yeah, Vishal and Chetan. So I think Chetan is on this call as a fund manager for this. That's the regulatory risk meter, and yeah.
Yeah, thank you, Krishna. And I would request everybody who's on the call to type any questions you have on this fund, or frankly, any of the funds we run, because this is the monthly webinar where we're going to discuss market outlook, but very open to take any feedback or questions you have on any particular fund. Uh, I'll just answer the first question that came in from Rajesh ji pretty much at the start. I think I provoked the question, which is, can I elaborate on the performance of equity savings since I mentioned it? Yeah, so frankly, there are some of these funds that, it's one of those that personally I invest in the fund, but I just find it strange that somehow, and I know a lot of distributors like the product because while equity obviously makes sense in the long term, you want an option if customer is saying that I want to be little risk averse, but I still want some exposure in equity. So just to give you context of performance, I think the last 1 year return as on date is something like 6.8%. It's still higher than the returns that any equity fund has given. Just to give you a context, the benchmark has given about 4.5% in that time frame. And the returns from a 2, 3, 4, 5 year perspective typically has ranged between 13 to 14% annualized. Having said that, I will just give you one caveat. The challenge with 5 year returns, one should all bear in mind, exactly telegraphs to 2020, right? Which is post COVID. So the returns will always look, even in equity, much better than they actually should be from an expectation standpoint. So 10, I would say 9 to 11% is probably a optimistic return expectation, I would say, going forward. And that is assuming that your return expectation from equities from a long term perspective is probably 11 to 14%. So that's basically the context of the performance, right? I mean, I'm not trying to seek to have this fund as a replacement for an equity fund the customer buys, but I'm saying customers who are reluctant to commit more money to equity right now, and at the same time, given their asset allocation profile, their goals, should be exposed to equity in some shape or form. I think this is a valid solution because the downside protection exists because of the net equity allocations typically ranging between 20 to 35%. And at the same time, 20 to 35% is not a small number. So if equity does do well, you still have some exposure. There's a question on the manufacturing fund. It has been slow, difficult to explain. Kindly clarify. Yes, I agree. I mean, honestly, in retrospect, from a timing perspective, we did this in June, and most of the manufacturing funds were launched at that time. Uh, my only point would be the concept that was underlying the manufacturing fund, which is that if you believe that in the next 5 to 7 years, India will become a $7 trillion economy plus or minus, you know, 3 to 5%, manufacturing is going to be a key driver of that growth. Government has gone n number of times to prove the amount of focus they have on that. So it is something that will come good at some point. But at this current juncture, it is obviously in the last 8 to 9 months, the manufacturing space has been somewhat of a laggard compared to other sectors. So that's reflected in the returns of that fund relative to other funds you would have picked. But my only point would be from a 3 5 year perspective, we are very convinced that it will happen. I see a response from Rajesh, 9 to 11% if it happens. Yeah, Rajesh, the point is that my argument is if typically 30 35% is the net exposure to equity on average over a 5 year period, and equity gives you, let's say, 12%, and then on the remainder, which is fixed income, you are going to deliver about 6 to 8 9%, then hopefully 9 to 11% becomes a average return. Uh, Mukesh Chotani ji, lots of same funds in the market. What is the USP of this fund? Uh, there are some other parts of the question, Krishna, that is more appropriate for you, but I'll respond to this why our fund. Uh, so honestly, Mukesh ji, that is always going to be a challenge for us because we are a relatively newer fund house, right? I mean, when we launched our multi-cap fund, it was one of many multi-cap funds. When we launched a flexi-cap fund, manufacturing, small cap, we hope, and I know from the money you've allocated for clients for us, that sometimes building a fresh portfolio, having an optimal size of fund to kind of manage, gives us a opportunity to create value, and give you an opportunity to offer to clients a product for them to look at, right? I mean, for example, you could have asked the same question for our value fund that we did in February. Why value fund? There are so many value funds already. But you can clearly see the impact of being able to create a fresh portfolio at the end of February, the results today, right? So I agree. I mean, you could tell the customer could say, listen, I'll buy an existing BFSI fund, but I just think an ability to construct a portfolio from scratch is always a nice time for someone. We, like I said, have a serious amount of bandwidth in terms of financial sector coverage within our AMC. So we are confident we'll do a decent job, right? Krishna, I'm going to ask the next set of questions and request you to reply because
Mm.
Mukesh ji has also added up from a geopolitical situation and an equity market future standpoint. Is lump sum or SIP the way to go at this point? And then there's a BFSI related question that came earlier, which I could also respond actually. Why is 20% kept for other sectors when there is so much scope for
Yeah.
BFSI itself? The answer is it's the standard offer document format that you have to follow. It trust me, we are not going to have a situation where you'll discover that there is a 15% allocation to technology in this fund, right? It's a standard practice. All equity funds follow that protocol, right? All equity funds say small cap will be 65%, but small cap funds do not have 65% of small caps. So 20% is a provision we've kept just in case we need it. Sometimes that 20% can also be used for international equities and so on and so forth. So you could theoretically buy a large financial services play overseas as well when limits open up. So it would be financial services, but it will not technically form domestic financial services and so on and so forth. So it's not an intent that we are planning to invest 20% in other sectors right now. It's just a provision. But Krishna, if you could just talk about what in this current market is your personal view in terms of lump sum versus SIP, and how does one play this geopolitical situation where, frankly, forget every day, every second hour, there is something changing?
Yeah, I think the news flow dynamics is pretty strong. SIP typically happens to be a good opportunity. Only thing my suggestion is that within SIP, please target some particular number, some particular drawdown in markets, if at all, at which you would like to be a far more aggressive investor rather than saying I'll still do SIP, because assuming you get your price points right, whatever you assumed at 5, 10, 15% correction, if at all you have those numbers in mind, then once you get those numbers, please don't wait for further SIP, and better to invest at that point of time, because what you wanted to invest in terms of price point has possibly already come. So that's one part. Yeah, clearly, geopolitics can play out for next couple of months because some more announcements on this tariff, etc., is likely. One way to look at BFSI specifically can also be that this is perhaps one of the most insulated sector from earning profile perspective. If you look at the entire BFSI space in India, where the Indian economy is, where partly our capital account controls are in place. Indian money stays in India, and money stays in India. It goes to either some bank or some investment opportunity or some FD product, etc., etc. So which means the direct impact of tariff on any of the BFSI companies on their business P&L is almost negligible. Only very occasionally some company somewhere might be hit with some tariff, and to the extent some lender to that company might get some implication. But on a very macro basis, this seems to be far more insulated sector, because even if India has to concede something on the tariff on the incoming products, again BFSI doesn't really fit, because finally it's a service. So I think from a earning perspective on this tariff based geopolitics perspective, my sense is BFSI is quite safe. Market volatility is part of it, which is the multiples rather than the earning combination for BFSI. So that's how I'll put it. Yeah, geopolitics does impact the prices, which is the valuation multiples rather than sentiments, rather than direct earnings, because from a earning perspective, BFSI remains almost fully insulated from whatever is happening on the tariff front.
Okay. Uh, there is a question on the consumption fund. I'm not sure Naveen's on the call, but Krishna, very quickly on consumption fund. Any views on consumption as a space?
So I think broadly consumption as a space is coming out little bit as a disappointment in last couple of years where what really did play out in that CY23, CY24 really was, the government focus on capex, and that clearly, pushed capex cycle slightly ahead of consumption cycle. If you look at last 12-month data points, starting right from the election outcome to, some state elections in Maharashtra, etc., to the union budget, which basically again gave, tax relief or tax break to consumers worth let's 1 lakh crore rupees odd. I think the broad direction is changed from government side. Instead of pure play capex oriented, they're far more inclusive or far more open to consumption led support system also. So the belief there is, the money flow to the system, which consumers might need either by way of a government subsidy through some schemes by some state or center government, or the actual income beneficiary through tax breaks. Maybe only thing which possibly can come in again based on a lot of media reports really is some sort of change or reduction in GST tax rates, which again can make products far more affordable. So you have all this combination of policy framework playing out, support system to lower income strata through policy on little bit of a, let's say, incentive to people on the lower income spend, incentive to people on the tax paying slab, and maybe later on the cost reduction through GST cut can also follow. So that way, net net positive on the same demographic thing. On other part of this, tech consumers saw some disruption, which I believe is now being adjusted, is because somewhere these platform based companies came up to gain a market share. uh, Partly the existing players lost little bit profitability, but I guess now those things are normalized in terms of the competitive intensity is broadly done with, and do expect other segment of consumption to pick up.
Sure. Okay. Uh, there's a specific question again on the manufacturing fund, which I'll just quickly answer because we just discussed it in our investment committee a few days ago. And then there's one more question on BFSI's portfolio construct. Krishna, I'll come to you in a bit. So, on the manufacturing fund basis, the corporate results that came through in April and May, any change in positioning or how is it positioned? No, there's no significant change. The
Mm.
only thing where we clearly see we perhaps are thinking differently from our peer group is we are more overweight on oil and gas relative to our peer group. And in some sense, the current geopolitical situation would suggest that that is a logical move, right? Because obviously, oil manufacturing companies uh, are in a position to gain. Geopolitical issues may mean supply disruption, which then gives us slightly more focus on the domestic oil manufacturing companies at one level. So, oil and gas, in some sense, has been a sector which has underperformed for a while, which means valuations are attractive. And if there's a tactical opportunity that comes to companies in that space, that's what we're looking to play. So, frankly, no other changes other than the fact that our overweight in oil and gas is clearly, and it's not a massive overweight, but that's probably one difference between the way we are currently positioned on the manufacturing fund relative to some of our peers. Krishna, the question on the BFSI fund, which I think is a question for Vishal, you, Chetan, and Kirti to answer. It, as you currently look at this,
Mm.
assuming for the 100 crores you get, let's say, I hope to God we get more than 100 crores, but
Yeah.
let's assume we get 100 crores, Krishna. What's the first portfolio broadly going to look like in terms of two questions? One is large, mid, small. And second, I'm adding two questions together: the extent of capital market related players in the portfolio and the extent of public sector players in the portfolio.
Yeah, sure. So if we do a let's say macro, I think we'll have less of banks and more of NBFCs if I just do the lending piece on one side. So let's say underweight banking, overweight NBFCs is one side. The other dimension really is lending piece versus capital market piece. I think will be overweight on capital market related activities through any combination, whether it's a asset management company or a exchange or wealth management, or or broking or fintech kind of combination. Uh, One particular aspect of this portfolio positioning also will come out via the higher share of small and mid caps vis-a-vis the large caps, because moment you decide to go little bit underweight on banks, you're essentially, a lot of banks are large caps. See, one way, on this BFSI, one needs to remember is that there are two kinds of BFSI businesses. One is capital guzzling businesses, which require higher capital requirements. They're partly entry modes, they're partly entry barriers to other people entering. But as of now, one looks at some businesses which are capital hungry, some businesses which are capital, I'll say, maybe efficient. Earlier I mentioned during the conversation about some businesses on price to book and some on price to earnings. So a lot of these capital market businesses where the capital adequacy is pretty high, they don't really need capital to grow much faster. That's a space, this price P based multiples will apply. I think those capital market plays broadly, everything qualifies in that bucket, where irrespective of capital, they can actually grow more and more with incremental customer acquisition, in incremental, wallet share of customer money, and growing there. So that's gonna be overweight on capital market on one side, and maybe NBFCs on the other side.
And Krishna, PSUs, public
PSUs,
sector players within the
we
space.
have some opportunities on PSU side, in some combination of either a PSU bank or a infra financing companies. Generally, we'll find some space in the portfolio for that, because that's a space which has got itself transitioned nicely from earlier challenges on the PSU bank side, and on the infra financing side from the sheer opportunity of somebody who's able to finance India's power sector needs. So that way, yeah, portfolio will have some presence there, assuming it was to be constructed today. But yeah, we have exactly 1 month in a way, to figure out actual portfolio. Some marginal changes based on how prices moves and valuations evolve can happen.
Krishna, two quick questions. One I will answer, and you can correct me if I'm wrong because I'm answering on your behalf, and then I'll address the second question to you because it is beyond my capability at this juncture. So, one is the question is how many stocks are we likely to hold in the BFSI fund? See, my answer is at any point in time, I would say the range will be 35 to 45, 50. And the reason why the range is so large is just think about it logically, right? If at a time when the fund manager is positive on banks, you can execute that positive view in banks because there are many large cap banks through four or five stocks very easily, right? And there were times when you're underweight banks, you're much more overweight on NBFC, capital market players, depositories, and so on and so forth. That will typically mean that you will have to allocate to a lot more. So it's kind of, when you have places that you want to invest that typically are more small cap companies in them, then you would probably have a number of stocks tending towards the 45-50. And when you have much more overweights on core banks, that's when the number will be more 35-40. If that's an accurate way to put it. Krishna, second question, Krishna,
Hmm.
what's the future on chemical sector? Is there any possibility that we'll ever come up with a sector NFO on chemicals? Let me clarify that. Answer is no. I don't think at this juncture chemicals has the ability for us to create a broad-based sectoral play at this fund and as a fund idea. And we really don't want to go down. See, we are not. This is just think about it this way. Our BFSI fund is our second ever sector fund after a long while, right? The other one being consumption. Uh, we don't want to confuse the customer as well as you by too many sector funds. If chemicals is an opportunity, we'll play it across all our diversified funds. But Krishna, what's the view on chemicals? It's been a darling of markets between 20 and 23, then a laggard for those 2 years. Lots of conversations I know about chemicals. What's the view on chemical space?
Yeah, so chemical, broadly as a category is positive, and like any other manufacturing product category in the world, a lot of these things depends on how things happen in China in terms of what sort of product portfolio China has, what cost advantage, or what competitive or anti-competitive pricing Chinese companies adopt vis-a-vis the vis-a-vis the world. From an opportunity perspective, yes, clearly, chemical comes up as a nice, opportunity because Indian companies have proven capabilities on the chemistry side. Maybe a little bit support from this tariff environment can clearly help, because uh, that competitive pricing, or maybe little bit of lost leadership in pricing by some Chinese companies can get adjusted or modified because of tariff, and that can really open up a nice opportunity for for India to start catering to the world markets. Look at India specifically. Yes, as India grows on manufacturing its own, every manufacturing process will require some combination of some chemical components, and those things again will be in turn made in India. So I guess structurally positive. The only challenge from a financial market angle is that chemical as a category has simply too many end products, and each of these end products have their own value chain of cost structure, stroke price realization, difficulty of logistics, etc. So to an extent, far more stock specific, and even if you look at the sheer number of companies available and the product range, again far many small cap companies you find in chemicals. So opportunity, yes, definitely. A little bit support from tariffs can help. Otherwise, core India story of manufacturing will definitely involve chemical companies to do well, even from a domestic consumption perspective.
Sure, thanks. Yeah, I think that brings us to the end of questions. So let me just quickly summarize for everybody. So the BFSI fund, very simply put, besides the fact that obviously it's an NFO, we'd like to get some money to be able to build a decent portfolio, etc. I also think that it has a business relevance in the sense that in a today's world where when you meet a customer or we're all talking amongst ourselves, we are discussing tariffs, geopolitics, uh, you know, economic growth slowdown, interest rates, the one space or the one sector that perhaps does not come up in that conversation ki which sectors will be impacted is BFSI. So if at all you're looking to make a play on a sector that will keep chugging along while we are faced with a period of time when we will always have these news flow, then we think this is a good product to offer to customers. I want to reiterate, BFSI will never be a core part of somebody's portfolio. It should be a satellite portion, never more than 5 to 10% of any customer's portfolio. Uh, and like I said, from a perspective of the last 2 or 3 years, where this sector has continued to grow profits very handsomely, but market valuations haven't kept pace, we are very comfortable in a sense from a valuation perspective that this fund launch is happening at an appropriate time. I will, before I close, just talk about one feedback that I had got from many of the distributor friends I've met over the last 2, 3 weeks. And that comment was, in some sense, a critique of the format of many of the webinars that all of us are holding for you. The fact is that when a webinar primarily discusses view on markets, view on markets beyond a point isn't fundamentally going to change every month, right? But because it's a presentation on view on markets, we will speak about that. And one of the feedbacks I got is that instead of every month us doing the view on markets, can we have a much deeper dive every time into two of the funds, where the fund manager who's managing that fund can very specifically take you guys through what the thought process is, what has worked, what has not worked, and how the fund manager plans to run it. So I think that's a great idea that's come from some of you. If any of you have a point of view, please talk to your RM so that I can get that feedback. But we will look to change the format of this webinar, where every other month we would prefer to do a deeper dive into 2 or 3 of our funds that obviously all of you have blessed us with money of your customers with, so that you get a lot more insights into the specific funds. Not only necessarily, as one person told me very that it's not even from a Mahindra perspective, right? If I have basically sold flexicap funds to my customers, uh, then if your flexicap person, if Fatima comes and tells us about how she's thinking about her flexicap fund, it's also going to give me some sense about how flexicap funds in general are being run in the space, right? So that's something that we're going to try and do. And yes, I do have feedback. Please please come to Nasik. Yes, sir, I will definitely try and do that as well very soon. Thank you so much for your time. Thank you so much, more importantly, for your constant support. And we hope to catch up with you in the third or fourth week of July again. Take care and have a good day. Bye bye.
Thank you.